every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Thursday the 17th of August. Coming up, we have the latest business and finance headlines and the best discussion on those stories in one of Hong Kong's most listened to financial podcasts. This is the original Money Talk. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, minutes from the Federal Reserve's last two-day meeting in July show policymakers concerned about the pace of inflation and indicating more rate hikes could be necessary in the future unless conditions change. The minutes showed officials unanimously backing the 25 basis point rate hike, and policymakers stressed that there are upside risks to inflation that could warrant further monetary tightening. However, some members expressed some uncertainty over the extent of transmission lags, raising caution against over-tightening. The decline in new home prices in China accelerated in July, with smaller lower-tier cities suffering the sharpest falls. Average new home prices in China's 70 major cities fell 0.1% year-on-year in July after edging up 0.1% in the previous month. It was the fifth month of decline so far this year. New home prices declined 2.5% month-on-month on a seasonally adjusted annualised basis. Third and fourth tier cities registered drops of 3.9% and 3.3% respectively. JP Morgan has raised its global emerging markets corporate high-yield default forecast, largely due to rising contagion fears in China's property sector from a possible country garden default. JP Morgan raised its Asia high-yield default rate forecast to 10% from 4.1%. However, that figure drops to just 1% if China property is excluded. And JP Morgan expects China property to account for nearly 40% of all default volumes in 2023. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Nick Marro, lead for global trade at the Economist Intelligence Unit. And discussing the latest developments in the oil markets is Vandana, founder of Vanda Insights. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Money Talk.
On Wall Street, US stocks fell for a second day after minutes from the Fed's July meeting, released Wednesday, stressed that there are upside risks to inflation that could warrant a prolonged period of restrictive monetary policy or even another rate hike. The S&P 500 dipped 0.8%, closing at 4,404. The Dow dropped 181 points, or 0.5%, to end at 34,766. The Nasdaq Composite declined 1.2%, ending the day at 13,475. The yield on the US 10-year Treasury rose past the 4.25% mark on Wednesday as markets continue to worry about prolonged periods of restrictive monetary policy. The 10-year yield settled 4 basis points higher at 4.26%. That's its highest level since June 2008, just months before the collapse of Lehman Brothers, which then ushered in 15 years of low interest rates. The dollar index rose to above 103.5 on Wednesday, heading for its highest level in 6 weeks after the Fed minutes struck a hawkish tone. The US dollar Japanese yen hit peaks of 146.4, rising above the 145.92 level that saw intervention by the Japanese Ministry of Finance last September. It ended the session in New York 0.5% weaker at 146.25 yen to the US dollar. And the PBOC on Wednesday moved again to boost fragile sentiment with a stronger than expected reference rate for the yuan and the largest injection of short-term cash to the financial system since February. The measures come as the onshore yuan fell towards its weakest level in 16 years against the dollar. It's trading 0.2% weaker at 7.2981 in Shanghai. And disappointing Chinese economic activity figures for July and the suspension of the publication of youth unemployment rate data dented sentiment in Hong Kong. Shares there fell for the fourth session in a row. The Hang Seng Index tumbled 252 points, or 1.4%, to a 2.5-month low of 18,329. The Hang Seng Index is down almost 19% from its January 27th high, pushing it closer to a technical bear market. The Hang Seng China Enterprise Index, which tracks the largest mainland companies listed in the city, was down 1.5% and has plunged 9% so far this month to become the worst performer among 92 global equity gauges. On the mainland, the Shanghai Composite was down 0.8% at 3,150, sliding for the fourth consecutive session, despite the PBOC cutting a key policy rate by 15 basis points. And Bloomberg sources reported that China has asked some mainland funds to avoid net equity sales as the market sinks. Doesn't look like that's going to help this morning though, because futures markets are pointing to a further decline for the Hang Seng Index of about 300 points. That's 1.6% at the open. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Thursday morning, let's welcome our regular Thursday commentator, Andrew Freris, the CEO of Econosis Advisory. Morning, Andrew.
Good morning.
And also with us, Nick Marro, who is lead for global trade at the Economist Intelligence Unit. Very good morning to you, Nick.
Good morning, Peter.
Minutes from the Federal Reserve's last two-day meeting in July show policymakers concerned about the pace of inflation and indicating more rate hikes could be necessary in the future unless conditions change. Minutes from the FOMC's latest meeting showed officials unanimously backing the 25 basis point rate hike, and policymakers stressed that there are upside risks to inflation that could warrant further monetary tightening. However, some members expressed some uncertainty over the extent of transmission lags, raising caution against over-tightening. Andrew, I suspect this doesn't come as a surprise to you, because on this show you've consistently said the markets are getting it wrong in assuming that we've reached a peak in interest rates and that there's going to be some cuts next year. You've been saying quite consistently that's not correct. I suspect there's nothing here that changes your mind.
Yes, to the extent that they repeated rather boringly that the data are not yet where they want them to be in terms of a consistent decline in inflation, and it was a little bit of a blah blah. But I keep going back to what Powell said, not in the previous to last meeting, that he just can't see inflation steady at 2% until 2025. That's very chilling. I'm not saying that was his forecast, but clearly he was pointing out that they are not going to relax, not this year and not next year.
This data, though, did come out before we had the last set of inflation data. The minutes came out before, or the meeting took place before we had the last set of inflation data, which did show that inflation is coming down, didn't it? So do you think that maybe...
Yeah, actually, Peter, I've got my Bloomberg screen in front of me, and very frequently you find comments, even in Bloomberg, that just don't reflect at all, at least what the numbers are telling me. Okay, CPI year on year, the last number, which was July, was 3.2, and in June it was 3. So it went up, not down. Okay, so of course the previous 3 or 4 months was from 5 to 4.9 to 4%. Wow, then to 3, then up to 3.2. All this is meaningless because you will need to have minimum 6 months, continuous numbers, all of them establishing a very firm trend. So to tell you that inflation is accelerating again, it's nonsense. But to tell you that inflation is falling permanently is equally nonsense. It did fall for a couple of months and then went up again. I'm sorry, it sounds like an economist. God, I hate this first thing in the morning. But well, there you go.
Yeah, I hate to point out, but you are an economist, Andrew.
Yeah, I know. So, very briefly, yes, I'm not surprised at all that they say the trend is just not there, and if necessary, we will go for another 25 basis point. Full stop.
Nick, the markets are in some state of confusion, aren't they, at the moment, about where we are in the economic cycle? Have we peaked or not in interest rates? Is inflation coming down, or is it still too high? What can you tell us? What are you seeing from the data? Because we're getting a lot of mixed messages at the moment, aren't we?
Yeah, well, I think mixed messages is definitely the right way to phrase it. I mean, if we think about where we were around this time last year in terms of trying to forecast what was happening with inflation and the rate movements, inflation has consistently surprised on the upside. And this has been despite the Federal Reserve doing all it can to kind of bring price pressures down rather unsuccessfully. I think it is encouraging in the sense that, we're no longer at the peaks of where we've seen price pressures just a couple quarters ago. But I agree with Andrew. The story for so long has been, what's it going to take for the Fed to bring prices down without plunging the economy into a really bad state? Can they thread the needle by doing this without torpedoing U.S. growth? I think on balance, the Fed has really positively surprised all of us. We're still seeing really resilient activity in the U.S. economy despite the tightening in credit conditions. I think the real worrisome aspect of this is, again, kind of what Andrew said, that 6-month transmission in terms of monetary policy and the delayed effect that all of this could have on future consumption and investment activity. And so the story around growth particularly is a bit more worrisome when we maybe look at 2024 in the early part of that year. But yeah, just to sum up, this continued kind of upside surprises, upside risks that we're seeing in inflation data, I'm still a bit worried that we're not yet seeing a trend of moderation.
But isn't the problem, though, that the Fed so far, it has got inflation down to around 3% without plunging the economy into recession? So the Fed can take a bow there because a lot of people didn't think that was possible. But if the Fed is going to insist that it's got to come down further and get to 2%, then it looks like there's going to be a whole lot more of pain to come, isn't there?
Yeah, that's exactly right. And I'll personally have to give them credit because remember a couple, maybe several months ago, on the show we were discussing the difficulties in terms of the Fed being able to do this. And I was quite pessimistic in terms of them avoiding, a technical recession. And they've done it. At least, if the data shows that they've done it. And that is something which is quite admirable. I would say that the one encouraging aspect of this is, at least in month-on-month terms, we have seen a declining trend since at least earlier this year. So that's one positive, sliver of news that we can hold on to. But at the end of the day, we've just seen so many surprises over the past couple of quarters that I'm still holding my breath.
Okay, well, Andrew, the issue seems to be actually, rather than having a soft landing, the US economy is actually gaining quite significantly in this third quarter. If you look at the Atlanta Now GDP Now tracker, which basically adds all the latest in economic data as it comes out into its model and tries to project what GDP is going to be. It's saying basically for the third quarter, US GDP is going to be 5.8%. It's got revised up twice now in the last couple of days after we had the retail sales data and then last night the industrial production and housing starts data. It looks like the economy is actually accelerating, doesn't it?
Well,
or do you not believe it?
No, it's not a matter of not believing it. Just, I'm sorry, it's so boring quoting numbers, but it is important. Unfortunately, that's the only thing we have. If I was to take the last 4 quarters, of GDP growth in the States, and these are the usual utterly meaningless quarter-on-quarter annualized. I'm sorry, it's my pet hate. But anyway, there you are, quarter-on-quarter annualized. It went 2.4, 2, 2.6, 3.2. Well, the last 3 quarters is accelerating from 2 to 2.6 to 3.2. It's doing very nicely. Whether it's going to hit 5, I have no idea. I don't know how the GN numbers are compiled and how they extrapolate to a 5% increase. That sounds a little bit exaggerated. Equally, I will go back to, if I was to go back 6 quarters back before, we had 2 quarters back on back negative. In other words, we did have a technical recession. So I'm simply keeping the last 4 quarters. It is doing very nicely, thank you. And I would not be surprised that if it accelerates again, on the third quarter. Sorry, on the third quarter, yeah.
Yep. So Nick, if we look at this, we've had now, if we look at this data, it's going to be basically the 5th consecutive quarter that the US economy has grown by at least a 2% annualized rate, regardless of whether we want to buy into the Atlanta Fed's GDP Now tracker of 5.8%. Nevertheless, the US economy is clearly accelerating despite these rate rises.
Yeah, I mean, I'm going to echo Andrew here in saying how much I hate how the U.S. does this annualized calculation. One of the things that we try and do is calculate out kind of the traditional year-on-year or quarter-on-quarter, like individualized quarterly growth rates. And if we do that, we're actually still expecting a deceleration, both in Q-on-Q and year-on-year numbers for Q3 and Q4. At the same time, these numbers are still positive. We have been consistently revising up our own forecasts for how the U.S. economy is expected to perform. I think the implications of this more globally, to move away from the numbers, are still concerning in certain ways. Clearly, the resilience that we've seen in the U.S. economy has not translated into strong trade flows coming out of Asia, for example, and that's been kind of a depressing factor for most of 2023 for a lot of East Asian economies. And so there's a bit of a disconnect here between growth in the West and growth in Asia. A lot of that's tied to inventory, destocking, etc. So the implications of this, I think, are still pretty nuanced. But the broadly positive takeaway from this is, growth is in a much better place now than people were kind of doom forecasting a couple of quarters ago.
And then what can we do about the trade out of Asia? You mentioned that's been pretty grim. I mean, if you look at the figures that we've seen out of South Korea, out of Taiwan, it hasn't been very good, has it? I noticed the South Korean government yesterday announced more measures to try and help exporters to try and, export to new areas and in new sort of sectors. But what can we do?
Yeah, that's a really good question. And I think when you look at these policy measures coming out of these governments like South Korea or Taiwan or even China, a lot of what those governments focus on is on the supply side. So trying to assist their own producers and manufacturers and cushion them from the fallout. These governments have very limited recourse to actually create demand in their overseas markets. I mean, what South Korea does isn't necessarily going to lead to an increase in consumer spending behavior or investment purchasing behavior in the US or the EU, for example. And really, this story is tied to very high levels of inventory stocks. We're starting to see a destocking in some major economies, which should help the trade picture later on. But that's been somewhat of a separate narrative to what's going on with the overall growth picture, which is why I mentioned before that this resilience in, say, the U.S. hasn't really translated into firmer trade activity coming out of East Asia. And the second thing is really what's happening in the global electronics downturn. We're still seeing really sustained pressure coming out of, say, electronics demand in ways that are going to have implications for Taiwan and South Korea, parts of China's export basket, Japan. That's really tied to kind of this normalization in life post-pandemic, but also the fact that I think the supply chain shortages that we saw last year really drove a lot of companies in particular to just fill up their inventory stocks and make sure that they have enough products on hand to avoid repeating another shock to their supply chains, shock to their their inputs of their various stocks. We're not expecting this scenario to materially start to improve until the end of this year, beginning of 2024. And that suggests that even with the more positive growth rates and growth headlines that we're seeing out of the US and other Western markets, there's not really going to be necessarily that much of a firm translation or pass-through to us in Asia.
Andrew, what do you think about this? The accelerating US economy, as Nick says, isn't really benefiting Asia that much, certainly not in terms of trade anyway. Is this because maybe partly American consumers are just not buying as many goods as they used to? They're spending their money on going out to restaurants and flying around the country and going to the cinema rather than actually buying sort of tradable goods?
The answer has to be a rather mixed yes. If we were to look at the export performance of the major exporters in Asia, including China, of course, that they have been going down, the rate of growth on a year-to-year basis is decelerating. The same thing, of course, with South Korea. The same, of course, the thing with Hong Kong. And poor Hong Kong is reflecting not only the performance, because Hong Kong doesn't export anything. Hong Kong re-exports everything. And that simply is a nice way of pulse taking to the extent of what is happening in the overall re-export trade in Asia, because Hong Kong doesn't only re-export Chinese goods, it also re-exports quite a lot of Asian goods. All of those are pointing downwards. Now, whom they are re-exporting all these things to? The answer is, if they were doing it to each other, then one should have expected that overall their exports would be going up. And the answer is they are not, because exports to the United States has been declining. The same thing with German exports to the US. So what we're looking at, we're looking not only exports to each other, but also exports to everybody else, has been going down. Da-dum! Not exactly a Nobel Prize winning conclusion into that. And the reason for that, of course, is twofold. One is that consumers, particularly in the major consuming countries like China, are spending a lot more inwards rather than outwards. And I'm absolutely fascinated what is happening with the tourist trade in China. China used to be possibly the second biggest tourist country in the world, the second being the United States, not forgetting that the United States, the tourist sector, is overwhelmingly inward looking. In other words, the Americans spend their holidays in the States. And now the Chinese are beginning to do this. And poor Hong Kong is finding this out. You might say, what this has to do with exports? A great deal, because tourism is another form of exporting. Okay, so this is another nice pulse taken by saying people are spending less. And it's not just anecdotal. Even if you were to take in the export performance, yes, they're spending less because they're spending a lot more at home.
Okay, well, one other aspect of this, before we move on to China in particular, of the Fed minutes and the strength of the US economy, the US 10-year Treasury yield rose above 4.25% last night, currently trading at 4.26%. The 10-year yield since the financial crisis has never traded for a long period of time above 4%, but we now seem to have got that as a floor. We've got to get used to this 10-year yield now being above 4%, maybe going to go even higher. In effect, this 15 years of low interest rates that we've been seeing is over. That's going to have some big impacts, isn't it, on investment flows, on trade flows as well, of course, and on the markets, Nick?
Yeah, that's right. I think if we try and extrapolate and look what's happening in investments, that's really what I've been trying to do for the last week or so. One data point that caught my eye, I think it was last week, was how, at least on a balance of payments basis, inbound investment into China has fallen to its lowest level in absolute terms on record. And I think that was over the second quarter of 2023. And I think in year-on-year growth terms, it was a collapse of around like 87% or something like that. One of the things that we're looking at here and why it's relevant to this conversation is you have the geopolitical risk story, the diversification story, the China plus one into ASEAN story, but also in home markets now, borrowing costs are just incredibly expensive. And what we're trying to understand now is this a story just around diversifying from China, or is there a fuller kind of global pullback in investment activity and FDI flows in ways that actually have consequences for China's neighbors as well? And based on some of the kind of initial data that we're seeing from other Asian markets, it looks like that this is very reflective of kind of reduced appetite for borrowing and consequently reduced space to expand or engage in new types of investments. And so I think with borrowing costs now at this decade plus high, this is really going to usher in somewhat of a transformative change into how business operates and how consumers, people have been talking about how this can affect consumption, and with the inflation numbers, maybe not. But at least how businesses kind of approach their strategies and how they look at kind of investment moving forward. And I think this is somewhat uncharted territory, at least for, the last 15 years, given that we have not really been in this high interest environment for such a long time.
Andrew, how significant do you see this bear, what they call the bear steepening of the US Treasury yield curve, where rates are going up, but going up even faster at the long end? This is, in effect, sort of reversing the inversion of the yield curve, but it changes a lot of things, doesn't it? Businesses, individuals who have their mortgages linked to the 10-year rate are going to have to get used to now longer periods of much higher rates. Do you think they're ready for that?
Also very, God knows, knock on their door and says, "Excuse me, ma'am, do you appreciate that the yields are up?" Like, they are? I adore this. I'm sorry, I'm sound almost patronizing. Look, I'm a simple guy and I like simple things. In general, long-term real interest rates tend to match long-term GDP growth. So if the GDP growth is sort of 2-ish, okay, and you have nominal yields at about 4.5%, and you are having inflation at about 3%, subtract one from the other, and you are sort of beginning to get near the 2%. Not quite yet. Okay, it is still real. Long-term interest rates are perhaps at about 1.5, 1.6%. So yes, I prefer to stick to that, and I would say once we hit approximately the 2% real interest rates at the same time that the economy is growing at 2%, okay, then this is a very steady, long-term kind of behavior that economies are known to hit. Although, mind you, there is nothing to trade in that. I could not possibly use it as a forecast because, of course, it depends which yield I'm using, depends which interest rates, which CPI numbers I'm using, and I'm using simple stuff, the 4% and the CPI inflation, and it is getting where I think it should be. So the answer is yes. Okay, the reality is that once we've moved away from the 2008, 2009 of zero interest rates, that has been the end of zero interest rates. God, what amazingly incisive news I'm bringing to your listeners, poor Peter. And that we have stopped having low interest. Really, the Fed has been increasing as if there is no tomorrow for 12 months. Now, Andrew is telling us interest rates are going up. Really? As the Americans say, really? Okay.
Except the markets, when you say the markets, some people in the markets do seem to be surprised. They're being taken by surprise by this rise in bond yields, certainly. But as we've just been saying, this is not a short-term phenomenon, is it? It's something we're going to have to get used to for a longer period of time. Let me switch to China because I want to get your thoughts on the economic data that we've seen this week, Nick. I mean, it was pretty horrible, wasn't it? Retail sales posted the slowest growth since December, up 2.5%. It wasn't that long ago. I think it was back in April where retail sales were going up about 14% year on year. Industrial production down, fixed asset investment down, investment in the property sector down as well. And we don't even know what's going on in the employment market because the National Bureau of Statistics cancelled the release of the youth unemployment data. But overall, it's not looking that good, is it?
Yeah, right. And I guess, there are 3 points that I would raise. One, to kind of echo what Andrew's been saying, none of this is super surprising to people who've been paying attention to the market. I think people have come to terms with the fact that the rebound from COVID has really underwhelmed expectations. And with all of the structural factors and structural shocks from the pandemic, say, disruptions to income and job creation and, various industry campaigns, whatever, the outlook has been pretty bleak for a while. I think it's been bleaker in the data prints than people were anticipating, so that's definitely noteworthy. But I think people are really reassessing kind of the outlook for the Chinese economy right now. We're seeing slashing growth forecasts across the board, which makes sense, and that's always kind of people are respecting this. But the second thing, which I'd want to highlight really quickly, is that with the retail data, the one upside to this is that it doesn't necessarily capture what's happening with tourism. So international tourism from China has still been really in the doldrums, but domestic tourism has been pretty strong. And if we use retail sales as a proxy for overall consumption, we have to be a little bit careful in the sense that the retail sales only capture goods purchases and catering. They don't capture tourism expenditure, and that could provide a little bit of an upside surprise to kind of the consumer landscape. But I want to caveat that saying, even if we do see strong tourism numbers, it doesn't necessarily mean it's going to translate to really strong headline consumer performance. The third thing, though, which I'll end on, is you mentioned the unemployment data being discontinued. And I think this is really part of a broader signal that we're seeing from Beijing about how authorities are growing increasingly worried about the economy. Officials really only discontinue data series when the data series look problematic. And particularly in the last couple of years, information opacity has increased as the economy has worsened and officials want to kind of dilute transparency over what's going on. That's worrisome. This is the second largest economy in the world. People need to know what's going on. And even though the youth unemployment figures have commanded a lot of attention, maybe a bit disproportionate amount of attention vis-a-vis other parts of the economy, they were still a useful proxy in terms of what policymaker priorities were, what that might mean for future policy support measures, what this could mean for official anxieties around new graduates entering the market. The fact that they've decided to discontinue that speaks more towards that anxiety and that clamp on information than it does to reassure investors that things are going okay. And I would say that as a result, the near-term outlook is pretty challenging, even if we assume that GDP growth is still going to be above the 5% target this year. At the end of the day, what does that mean? I mean, if the numbers are still positive, but companies aren't getting good returns, people can't find jobs, imports are still cratering, meaning that China's ability to contribute to global demand has really fallen back. All of that is somewhat inconsequential at the end of the day.
Okay. I mean, Andrew, can I get your thoughts on this, on the news to discontinue the youth unemployment data, which was already at a record high, over 21% last month? We can only assume, I suppose, that it was going to be another record high. But what are your thoughts on that? And in particular, the impact on foreign investors, what they would think about this?
Well, this was incredibly unfortunate. I mean, the timing was really extremely poor, even if they say that it is due to demographic reasons. Well, you can carry on publishing it, saying, take that with a huge pinch of salt, okay, and we are working on something else, as opposed to simply saying, these statistics look terrible, we're going to discontinue them. Come on, I don't think for one moment they meant that. Look, however, the one, for me, which again has been massively misquoted in the markets, is the year-on-year number of new home prices in 70 cities. And this has been going down, take a deep breath, for 16 continuous months. I mean, if that doesn't put you in a pretty lethal mood, I don't know what will. Given also, of course, that the property sector is packed with good news. Everybody right, left, and center is in inverted commas defaulting or threatening to default. This is pretty bad. And also, Peter, the retail sector is again very much distorted of what we are seeing by the friend of the Economist, the low base effect. I don't know what we will do without it. Okay, April and May were spectacular because they were year-on-year on negatives. Then, of course, June and July were much, much lower because they were on positives. And, of course, July came down to 2.5. So take a deep breath. We had April, 18.4%, May, 12.7%, June, 3.1%, July, never mind, we won't talk about it, 2.5%. That is a distorted number, okay? In other words, the retail sales, okay, have not really been improving. So this is not really good, bad news, okay? These are bad news over a long time trend. And then, of course, we have the GDP numbers, that, nothing sort of spectacular, particularly the second quarter at 6.3%. And, I suspect the fourth quarter ain't going to be as good as that if consumption continues to be going down, and, of course, investment. And then we may just end up with China growing at 5% to the utter disbelief, okay, of the stock markets, and then also to the utter indifference of the stock markets because they keep going down. Remember, GDP growth is backwards looking and traditionally was never a very good proxy for telling you where the stock markets are going. Mm-hmm. And most definitely, it's doing that with China. The stock markets are going down and the GDP is going up.
Okay. Nick, final quick comment from you on this housing data. Let me quote you the number. New home prices declined 2.5% month on month on a seasonally adjusted annualized basis. Andrew would love that statistic. No idea how you get to a month on month seasonally adjusted annualized basis. But nevertheless, new home prices down 2.5%, even worse in third and fourth tier cities where the drops were 3.9% and 3.3%. Must emphasize, of course, that's a seasonally adjusted annualized basis. Nick, a quick comment from you on this, because this is where Country Garden, isn't it? I mean, Country Garden operates mainly in these third and fourth tier cities. Things are not.
Don't do that, Nick. Don't do that, Nick. He's leading you on. Don't do it.
Yeah, I mean, one thing that we've been really worried about since zero COVID ended in December last year was this discrepancy that we'd see between kind of the first and second tier cities and the third and fourth tier cities. And so that's what I'll focus my comments on. I mean, we've been pretty pessimistic on the growth prospects for these smaller, poorer Chinese kind of urban centers, as well as the poorer, smaller provinces in China as well. And that's really maybe the big macro narrative we're looking at, this kind of sustained and deepening divergence between kind of China's wealthier, bigger cities and its smaller, poorer cousins. I mean, these are that, and that's going to be one of the big issues in the property sector as well, given that a lot of the economic activity over the last decade in these smaller cities was tied to property, and that has consequences for developer financing, financial risk attached to the local financial sector because of their exposure to these property giants who are all now struggling to keep their head above water. I mean, that's really one of the big stories here. Looking at the outlook, we've been pessimistic about property for quite some time. The numbers that we're seeing seasonally, annually adjusted, I think reflect officials trying to grasp with desperation any sliver of good news that they might be able to translate out to the market, but the market doesn't really seem to be having it. And so, yeah, I don't think we can expect to see any type of real turnaround in the property narrative anytime soon.
Oh, okay. Well, thank you both very much. That's Nick Marro, lead for global trade at the Economist Intelligence Unit, Andrew Freris, who is the CEO of Ecognosis Advisory. Oil prices were choppy on Wednesday, but ultimately lower as trader weighed concerns over China's sputtering economy against a bigger than expected draw in US inventories. Joining me now to discuss the trends going on in the oil markets is Vandana, founder of Vanda Insights. Morning, Vandana.
Good morning, Peter.
It's been a pretty good sort of time for the oil market since about mid-June, wasn't it? We've seen quite a decent sort of rally, although the last few days it seems to have sort of come off at the moment. But lots of conflicting things going on in the oil markets at the moment with China, with the Saudi Arabia production cuts and so on. What do you see as being the main factors we should be looking at right now?
Yeah, so over the past 6 to 8 weeks, two main themes have dominated the oil markets, both of them being very price supportive factors. One was, of course, the OPEC, non-OPEC cuts, production cuts, and these are, just to put them in context, the deepest cuts that the alliance has made since May 2020, which was at the height of the demand crash caused by COVID. And these cuts have begun to bite. Supply in the physical markets has tightened. So that is always a supportive factor for crude. The other one, and probably a bigger one, was the optimism over the U.S. economy, over the soft landing narrative that it became quite embedded and entrenched in the markets. Now, it's the second one, I think, which is more volatile and susceptible to revision. Investors may just change their minds over what they expect the Fed to do, how inflation is expected to shape up, and so on. And that's what we saw last night as well. A little bit of a wobble in that optimism, which pulled prices down.
And why is Saudi Arabia doing these cuts? Because it's sort of almost gone out on a limb, hasn't it, on its own to do these production cuts. Why now? Why is it doing it now?
Yeah, but I think there's a short-term factor and a longer-term one here at play. One is, of course, the vast majority of OPEC Plus members do want prices at a higher level simply to balance their budgets. And let us not forget, they made major losses. And, some of these, like Saudi Arabia, the sovereign wealth funds suffered quite a bit as well over the two COVID years, shall we say, 2020 and 2021. So they need to recoup that. Longer term, there is this deep-rooted fear now amongst major producers and exporters that they do not have much runway. As the world transitions away from fossil fuels, they may end up sitting on stranded resources, just having to leave their oil and gas molecules in the ground. So they are trying to extract as much, monetize it and extract as much profit out of it as they can. For the time being.
So where do they want to get oil prices to? At what level will they be happy and say to themselves, we don't need any more production cuts?
The de facto leader, which is Saudi Arabia of the OPEC Plus alliance, and even if you talk to other ministers of the other member countries, they always are at pains to distance themselves from any price targets. But so it's something of a guesswork within the market always. But initially, when they began cutting earlier this year, the idea was that they were trying to put a floor at around $70 per barrel for Brent. I think that's the level they would still try to defend. Of course, prices have been way above that. As I mentioned earlier, it was what they hadn't probably expected was this major uptick in sentiment over the U.S. economy, which became a tailwind for oil prices. But I think above 80, of course, they are even happier to have prices at those levels. But they will definitely try and defend at least $70 a barrel if it comes to that again.
I mean, it did sink, wasn't it, to about 68 in June, and then we've seen this sharp rally in the oil prices. And Saudi Arabia has extended these production cuts by another month. Presumably, they could carry on doing this month after month. So if it isn't a particular price target, what is it that's going to stop them eventually from just extending these production cuts? At what point will they say, OK, this is enough?
Yeah, that's a great question. I would think that they would step back, and especially Saudi Arabia with its incremental cut that you're referring to, which has been, especially hawkish move by the kingdom. If there were signs of a much worse economic slowdown, shall we say, at least in the major economies, or a recession, I think they wouldn't want to try and sustain prices at, let's say, high $80 a barrel or even 90 while the world is spiraling into a recession. So I think that would stop them. But short of that, as long as there is demand, as long as consumer countries, importing countries are willing to pay, I think there's really nothing to deter them from trying to keep markets very tightly balanced.
And you mentioned the US economy. If we look at the US economy and the impact on the oil price, we've got, first of all, the 10-year bond yield now persistently above 4%, at 4.25% last night. So rates are clearly going up. But at the same time, the economy seems to be improving as well. We had great retail sales data, industrial production data last night. The housing starts numbers were good. So the Atlanta Fed is now predicting 5.8% growth in the third quarter. I mean, this would be astonishing. But presumably, if we were to see that, or even anything like that, that's going to be another big factor on the oil price.
Absolutely. I think the jury is still out on exactly what sort of landing the U.S. economy sees. Whether recession, what degree of recession, and so on. But on a day-to-day, short-term basis, what happens in the oil complex typically is simply tracking the risk appetite in the broader financial markets, which in turn of course, is guided by what investors are betting in terms of the U.S. economic outlook, of course, but the subset of that is what the Fed is expected to do, what inflation is expected to do. Now, I suppose it was understandable that, inflation coming down quite sharply, and as you've just mentioned, the U.S. economy on quite a few metrics has been quite resilient. My problem with this whole narrative defining the sentiment in the oil complex is that, yes, the U.S. is the biggest oil consumer, but it's not really the consumer or the growth factor at the margin for the oil markets. It's China and broadly Asia. So the oil market for quite some time now, over the past several weeks, has actually just completely discounted the slowdown in China, the biggest contributor of growth in terms of energy demand, and the slowdown in Europe as well. It has been too focused on the US. So I guess it was time for a correction, and maybe that's what we are seeing now.
And presumably the data showing crude stockpiles falling more than expected as well. That's another factor, isn't it? That's supporting the oil price.
You notice that was quite a bit on the periphery of the market yesterday, not surprisingly again. That has been the case. The weekly data on U.S. stockpiles that you're referring to is traditionally a major factor in how in impacting price movements, but it has been a little bit on the sidelines because, I think it's more the economy the outlook over the economy, the US definitely, but also what is happening in China and to some extent Europe, and OPEC plus cuts. I think the market has been just very focused on these factors. So I wouldn't expect the US stockpile changes to come back center stage anytime soon.
Do you think, you mentioned China, do you think China is going to become more of an issue for the oil markets? Because the data we're seeing, the economic data out of China, is pretty grim, isn't it? So it would suggest quite a sharp slowdown in the Chinese economy. We've got major investment banks now revising down their forecasts for GDP growth. But as you say, the oil markets anyway, seem to have ignored it so far. But do you think that's going to change?
Indeed, very dark clouds over the Chinese economy, and some in the oil market, or probably more the consensus view, I would think, is that the economy will pick up steam. Earlier it was believed to happen in the second half. Now some people have pushed it back to, the fourth quarter of this year. I am not in that camp. Having looked at China quite closely over the past decades, sitting here in Asia and Singapore, I can see very deep systemic and structural issues in the economy, which point to a very, very slow recovery. So perhaps in terms of its oil demand rebounding, that's a word I would use very carefully, probably well into 2024. So I don't see that happening anytime soon. I think that ought to weigh on oil prices. It didn't in the past few weeks, as we saw crude prices spiral up to multi-month highs, was probably because it had been gradually factored in. So if you look back right to March, April this year, we have had a very sustained disappointing data from China. So to a large extent, I think that is baked in as par for the course in the oil prices.
Well, we've mentioned the two largest crude oil importers. What about the world's third largest crude oil importer, which is India these days? When we last spoke, we talked a bit about India, doesn't it? Is it still an important market now, particularly for Russian oil, because they've been big buyers of that, haven't they?
Yes, Indian economy has been doing very well. I guess a major point of distinction is, unlike China, it is not too dependent on the overseas markets and exports. Indian exports have taken a double-digit tumble as well, but nobody talks about it as one does of Chinese exports, for instance, declining by nearly 15%, because the Indian economy is more sustained by domestic demand. So it's doing well. Indian oil demand is also growing at quite a healthy clip, but again, it is a bit marginal when it comes to talking about the global oil supply-demand balances, because it is the third largest consumer, but consumes just about a third of what China consumes, for instance, and about a fourth of what the US consumes. So it's there. The oil market participants keep a close eye on it, but it doesn't really impact your outlook when you are trying to weigh global oil supply-demand balances.
Vanda, thanks very much for joining the programme this morning. Always good to talk to you.
Thank you so much, Peter.
That's Vandana, who is founder of Vanda Insights.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on developments during the Asian Trading Day. I'll be back tomorrow with another episode of Money Talk. I'll be joined by Francis Lund, the CEO of Geo Securities, and Christopher Lee, partner at Farron Augustine and Alexander Investments. With a view from Australia and New Zealand is Mike Gibbs-Harris, Director of MGH Asset Management in Wellington, New Zealand. See you tomorrow.
Money Talk.